This podcast is for entertainment purposes only and does not replace your own financial, tax, legal, or financial product advice. And a heads up, this episode contains sensitive content that may be upsetting for some listeners. Please read the warning in the show notes before listening to the episode.
If you're new to the My Millennial Money world, you may not know, but I talk about the Sound Financial House. And the premise is to get your solid foundations in your life sorted, then you can build your financial life on top of that. The 4 foundations are to be cashed up and debt-free. It's to have a spending plan in place or a cash flow system or a budget, whatever you want to call that, a system that works for you. The 3rd foundation is a personal protection package, and part of that is your income and life insurances. And part of this episode today is talking about underwriting and the process of getting insurance. And the 4th foundation is having your wills and estate plan set up. 4 foundations, they're done. And then build your financial house however you like. On today's episode, I'm joined by our resident insurance expert, Phil Thompson from Skye Wealth. Welcome, Phil.
Thanks for having me, Glennie.
Thanks for coming back to the podcast, and thanks for joining us in, where were you? Bloody Brisbane, Sydney, Melbourne.
All over the place. Oh, yeah, we did.
Did you come to Adelaide? No, you didn't.
Yeah, I did. I was in Adelaide.
Oh, you did?
Didn't go to Hobart. I had COVID for Canberra and didn't want to go all the way to Perth.
So you've heard Phil on the podcast before. I believe in getting experts in our corner in every area of our life. And when it comes to life insurance, it is a complex specialty. And we are just talking about underwriting. But before we do get into this chat, I just want to put out there that every single example and every single comment that we make today, it's so circumstantial, and you need to get advice on your own personal situation. As you know, we've got Tal, our show partner, on Tuesdays, but I wanted to do this episode with Phil, who is a licensed financial advisor who works with a variety of different insurance companies, because there are cases where different insurers will be most beneficial for different people. And I just want to say, like, Tao, they're a great insurer, and Phil and many of you have and use Tao. Like, Phil uses lots of Tao. A lot of you have Tao products. But just in terms of a 101, this is Unky Glenn here chatting on the podcast. You know, I'm pragmatic enough to know that, you know, not every product that we talk about is for everyone. All that to say, Phil, did you want to say any opening comment, and then we'll get Nathan to put the bump in and we'll get started?
Yeah, also just to touch on that as well, like Tao as an insurer will also say that they have certain rules and underwriting assessments that other insurers may be more favourable on, and vice versa. So that's why it's really important. And we'll discuss this a lot in detail as to, you know, just because you get one outcome from one insurer doesn't mean that's a house rule for everyone.
Perfect. Well, that's a good time to run the bump, Nathan. Let's get into this episode. So in the Facebook group, we put up a question around the claims process for the Towel episode. I don't know when that's gone up, but whatever. But a lot of the questions are actually underwriting questions. So I'm like, look, Phil, just jump on. We'll just answer these. If you wrote anonymous, we won't read your name. But James Robson said, what does fully medically underwritten actually mean? And how come our super insurance doesn't have us do it? So a lot going on there.
Yeah, so we'll just touch on underwriting, what that actually means. So, and kind of just even higher level, what the difference between personal insurance cover is versus like home and contents or car insurance. Like with home and contents, the insurance company has got a lot of data around where you live. Is it a brick house? Is it, you know, what are the tiles on the roof? And if you can provide that data, then they'll have the statistics to understand the claims on that and how likely is it that you're going to be in a floodplain or something like that. The difficulty with personal insurance cover and what underwriting is kind of the art form of going, what is the risk of Glenn claiming on this cover? What is the risk of Phil claiming on this cover? And it is so very personalised for each individual person. So when we talk about other questions that we're going to go through, underwriting is a insurance company making a risk assessment. So what is the risk of a future claim?
And I will say, Phil, you talked about the home and the content insurance. Absolutely, that policy is underwriting, but it's almost computer underwritten because they've got so much aggregate data, right? the most common way that you might feel the underwriting process in your day-to-day life is when you insure your car. They say, is there hail damage on the car? They say, is it roadworthy? And that's an underwriting question. And that's probably one of the most manual yes or no questions a car insurer will ask you, because if you've got hail damage on your car, or if it has been written off before, it's uninsurable, because the chances of you claiming are 100% it's going to be a claim. And Phil, maybe just talk conceptually about the insurance pool in general, whether it's car, home, contents, life insurance, income insurance. How does the insurance pool work in the world, basically?
Yeah, so this is how the way I try to explain insurance. Insurance is just a collection of people coming together, putting money into a bank account and saying, if anyone needs that money for a certain thing, they can pull money out of that bank account. And so that's really what like car insurance is. That's what life insurance is everyone just pooling money together. And that pool of money can, earn a rate of return and can be invested. But the money that goes in needs to pay for the money that goes out. So it's really a socialist system. I'll pay heaps in premiums and I may never get anything in return. And you may pay 1 year's worth of premiums and you get $1 million claim after a year. Yeah.
So for example, I'll make something wild up. For every $1,000 that I put into the insurance pool, for example, the insurance company might carve out 10% as profit. They might carve out 20% as operational costs. They might carve out another 10% for marketing. So we've got 40%. Then the 60% goes into the pool.
Yeah, exactly.
That will actually... So, and it's just so important, Phil, that we need to understand, because the most outraged comments we get in the Facebook group are when people have exclusions or declines for personal insurance. And, I've had declines, and I'm happy later in the episode to open up one of my policies and tell you exactly what I've been declined for, what I've been excluded for, what I've got loadings for. So it is just about ensuring the sustainability of that insurance pool, isn't it?
And that's exactly right. The sustainability is really important, because at the end of the day, it's not just the insurance company making the call. The insurance companies in Australia, they've got another insurance company above them who is also protecting their book and their business and the one paying out the claim. But on top of that, we've got a regulator who is making things very strict, because the regulator says to the insurance companies, if you're going to give out a policy that is a high-risk policy, you need to hold a whole bunch of money as capital reserves to guarantee that you can pay out that claim in the future. So a lot of the changes that happened last year and the year before was about the regulator stepping in and saying, hey, this pool of insured people is maybe too generous for the amount that you're charging. And so we've got to kind of restrict some of these things. So it's not just the one insurance company who's, maybe declining and being unfair, but it's also the regulator saying, hey, we need to make sure that there is money left to pay out these claims in 10, 20, 30 years' time.
Yeah, and we have had, everyone, you may not have heard the word over the last couple of years, the word unprecedented. It's a new word, Phil. No one's heard it in the last couple of years. Over, say, the last 8 to 10 years, we have seen personal insurance costs increase. We've seen a lot of insurance costs increase, but back to, say, like the income protection, that insurance pool has just been hammered because the policies have been too good and the insurers haven't been able to get a return with low interest rates on the pool of money. So it's just been a wild ride.
Exactly. And just going back to that analogy, more people are pulling money out of the account than are putting money in. So the insurer, as the kind of the caretaker of that pool of money, says we need to raise everyone's premiums because of it.
So just a quick structural lay of the land, and we will get back to James Robson's question.
Yeah, we promise. We'll answer your question, James.
Yeah, we might. We're just catching up. It's just Phil and I. We're friends. We just catch up. So in Australia at the moment, there's 10 retail insurers?
Yep,
life insurers? Yeah. So within those 10, each of those insurers, they've got a insurance pool that they've got to manage. They've got a business that needs to run and be profitable and be sustainable for the future. And they've got to look after their policyholders, right? So, and that's why it's just important that we have Phil answer these questions because he would write business with all 10, 11 companies in Australia. And, we talk about fully medically underwritten. Each separate company will have their own criteria for what they're comfortable and the risks that they're comfortable taking on. I mean, this is a wild example, but a million years ago when I was an advisor, if I had a commercial airline pilot, we would go to ComInsure, or if I had a police officer, I would go to MLC, because they were the two companies that really were catering for those people, and they would price the policies and have policies specific to that industry, right?
Yeah, exactly.
So back to James's question, what does fully medically underwritten actually mean?
Yeah, so at the start of the policy, so before an insurance company will accept the application, they will do a medical assessment. Now, that starts with just a phone call and a disclosure over the phone. So most of them are yes and no questions. Have you had any treatment or symptoms for mental health in the last 5 years? Have you had any back injuries or symptoms or treatment over the last 5 years? So it's all yes and no over the phone. And then that will trigger additional requirements if they need to, just to make sure they can fully assess you as an individual and your health history. Because once the insurance policy, once it's fully medically written and it's a direct policy between you and the insurance company can't change their mind later. You hurt your back 5 years in the future, well, they can't go back and add that exclusion. So that's what fully medically underwritten means, is at the time you're applying, they will do that risk assessment upfront.
And the reason why that is so important is because you want to take the time to go through your health history before you take out a policy, so you've got absolute certainty when it comes to claim time, because every insurance policy, you're buying a claim. Now, conversely, there are policies, and often seen on daytime TV and all that crap, where you might apply for a policy, or you do a tick and flick with your mortgage broker for some tack on insurance policy that is pseudo underwriting. Like, they'll say, oh, do you smoke, and what's your date of birth? And they'll get a basic information, Phil. But the danger is, if a claim ever arose, at that point, they go through your health history prior to the policy being taken out with a microscope to see if they would actually pay a claim if there was a pre-existing condition in that policy.
That's right, yeah. So some contracts, and just the second part of James's question is, how come super funds don't do that? Because they have sometimes inbuilt in their contracts that has exclusions for pre-existing medical conditions. So they just, lower friction. The daytime TV shows will say, well, they actually advertise no medicals. And that's because inbuilt in the actual contract says if there's a pre-existing condition, we won't pay out on it, or we won't pay out for a certain number of years on it. And so the reason super funds don't do that is because every member of the super fund can just get a group policy. So they can be a part of that group, and overarching, there's a risk assessment for that group. But if you ever want to increase your cover within super, then they will ask those questions.
That's right. So just as a housekeeping thing as well, like, we are talking about retail insurance policies in this episode, which are set up for you by a financial advisor. And if you want more of a deep dive, if you are new to the podcast or you haven't heard the episode, I think we did 2 episodes, Phil, episode 414 and 414B, and we just go a bit more deeper into the specifics of types of cover and whatnot. But today we are just talking about underwriting prior to you getting a policy. And for me personally, I would rather the time taken before I get on risk, before a policy is written. So if I do have the worst medical event or the worst accident, I'm not worrying whether we have to take these months and months to get doctor's reports to see if I get a claim paid, right?
Yeah, that's right. And the thing about like the retail cover and what that actually means, because, this is all a bit of jargon. It's all insurance, isn't it? If I'm going through super, going direct, going through an advisor, it's all kind of the same. But the reality is that retail cover versus super, if we just touch on those two things, is the retail cover, you own the contract. Once you sign up for it, the insurance company agrees to your medical history and says, yes, we will or won't pay out on X, Y, and Z, and they cannot amend that contract on you. Under contract law in Australia, they can't just go and rewrite it whenever they want to. But the other types, they can.
Yeah. So it's just, we need to understand this stuff because it is such a crucial foundation in all our financial lives. Any other comments before we move on to the next question?
No, just to reiterate James's question, why don't super funds do it is because they offer low levels of cover and it just reduces the friction when signing up for the super fund, because the super fund's aim is to bring in as much funds into the super fund, because the actual insurance that the super fund provides is all outsourced. So that's all lost money for them. They don't actually make
so
money.
if you've got an Australian super fund with death, TPD and income insurance in that account, Australian Super is not the insurance company. Australian Super go to an insurer that provide a group cover and they will organise a group plan for their members, because as a trustee, they have a responsibility to look after their members. And those contracts usually can change every 3 years, and that's why you might get some real wild letters in your mailbox from your default super insurance companies, because they might negotiate different rates and different benefits and policy terms every 3 years.
Yeah, exactly.
So I just wanted to say maybe some myths. So if I want quality, medically underwritten retail life and income insurance, Phil, do I always need to get a medical? Do I need a blood test? Do I need to go to my doctor?
Yeah, it's a good question. Generally, no. Most of the time, it's actually no. For most of the people in the My Millennial Money community, it's as once you start getting really high levels of cover, the insurance companies have like what they call mandatory medicals. So if you get over $2 million, well, they need to have some actual mandatory medicals. But for the most part, it's a disclosure over the phone. Any additional information the insurance company want, they will go direct to your GP and get a report, get them to write the report so they can get some additional info.
So just getting really practical on that, I'll just use me as an example. I want some income insurance and I want some death cover and some lump sum covers. I fill out the forms. Yep, I want 500K death TBD, 100K trauma. I want income protection with a $5,000 a month monthly benefit. If my health history is, pretty normal, or I've had some issues and the underwriters can see that, he had eczema and that's not an issue, and, he broke his femur, what's the femur, whatever, 5 years ago.
The leg or the arm?
Yeah, whatever.
One of them.
And that's healed. Yeah, we're happy to take on that risk with no mandatory medical tests or blood tests. So ordinarily, if I was in good health with those levels of cover, it's a personal statement of health, which is the questionnaire that, a lot of your clients, Phil, will do over the phone with the insurance companies.
Yep. And
that's all well and good. Now, if, for example, I said, I've had some high blood pressure, or I've been on this ongoing medication, it's stable, the practical thing is the underwriter will say, hey, I need you to sign this authority. We will write to your GP to get your GP to fill out a report. And what happens is the insurance company will pay your GP or medical specialist to complete a report based on the questions that the insurance company asks your GP, or they may ask for some other copies of maybe some imaging or something like that. So that's how it works practically. And sometimes the reason it does take a long time to get cover put in place, like could be 3 months, right? Because a lot of the time it's sitting at a doctor's surgery waiting for the GPs, because they're busy, right, to do the paperwork.
And that's why, this morning when someone asked me how long can the process be, I'm like, well, look, anywhere between a month and 6 months, depending on your medical history, depending on if we need more information. Because like the difference with home and contents, insurers can really easily assess based on a whole bunch of data points, and their computer can do that. But we're all each individual special snowflakes and special butterflies with our own kind of niggles and our own kind of drivers, and the insurance company needs to assess that. And so that's why it does take time and can be quite painful to set up, to be honest.
Likewise. And if I disclose that 3 years ago I had a blood test, my blood sugar was low, or some other thing that may have happened, the insurance company might say, hey, Glenn, we're going to pay for a nurse to come to your home or workplace at our cost at a reasonable, time and location or whatnot, and we just want some blood tests. And that happened to me. I had a nurse come to my house, do a blood test, and I could elect for them to send a copy of those blood tests to my GP. So my point is, you want to go through this process when the insurance money isn't needed, as opposed to getting a policy from the TV or some cover through a super fund that's default. And then when there is an accident or there is a health event, I don't want to be held up for an insurance company to double check your medical history that could take 2 months or 3 months, right?
That's right. And for, 90 or 80% of our clients, most people aren't getting a nurse to their house. Most people aren't getting this. It's just a phone call over the phone and then just a waiting game for the GP to respond to the insurers.
Another thing, and we will talk about it, there was a question in there about BMI, and we will get to that. But for example, actually, we'll talk about it now. So BMI, we know it's not the gold standard of health, but it is a good guide for insurers to quantify data.
That's it. And we're going to talk a lot of the questions about exclusions and all of this. And at the end of the day, it's all about an assessment of risk the insurance company want to take on. The amount of times I've been lectured about how useless BMI is, and I don't disagree whatsoever. But this is a metric the insurance companies collectively all use. And so unless we're willing to set up a new insurance company and have our own new assessment on BMI and how useless it is, at the end of the day, that's kind of the rules of the game, is insurers assess health on BMI. And the reason they do is because it's not like something like if I break my leg yesterday, they can kind of exclude my leg. And they can kind of pencil my, around my leg and say, we're not going to pay out on that. Something like BMI, there are like multiple kind of effects on, height and weight and how that does impact the health. And so that's why they may charge you more. So they put a loading on for BMI. And it's also not just that on its own. If you've got high blood pressure, if you've got, PCOS, like other factors will kind of combine together to have its own individual outcome based on your personal health history.
Now, I will say on that, you talked about loadings. So there are instances, and we'll go to Christina's question here. Yeah, I would love to know why I got a mental health exclusion and 100% loading because of my mental illness a decade ago. Exclusion and loading? Seriously? What a rort. So I've got the exact same situation as the questioner here. It's actually, I can't take it personally that I've got a mental health exclusion or a loading on my trauma policy because I've had polyps removed as part of routine colonoscopies. I'm just a bag of chemicals that needs to go into the insurance data machine, right? Like it's not the insurance company being, I don't know, like...
I mean, it is personal. It is people.
It is, but I mean, it's just
because an insurance company is making a personal judgment about your health history, and you know your health history better than the insurance company does. However, one thing I will always communicate. Well, I mean, there's a few things here. If something happened 10 years ago, underwriting isn't a set of rule books that never changes. So it would be worthwhile touching base with an advisor and just reassessing if that may be the outcome then, but it may not be the outcome today. And given you may be 10 years away from whatever the cause and the symptoms of it was, that may have a different outcome as well, because time can be favourable when it comes to underwriting. So the goalposts are always changing. So yes, that was a rule 10 years ago, and we've had the exact same client situation. Like it's not outside of the realm of possibilities, but there are probably other factors involved than just simply mental health.
But I just want to add, the insurance companies, as far as they see it, they get to underwrite once on a policy, right? Now, if I had a BMI that was a little bit higher and they said, yeah, Glenn, we'll give you the cover, but you have to pay a little bit more because, again, they want you to pay a little bit more into the pool because statistically, a higher BMI than whatever's considered normal could lead to heart disease, could lead to diabetes, could lead to a whole heap of other stuff. So they get to underwrite once. So it's like high risk BMI, pay a little bit more. Likewise, if I'm a bricklayer or a hardcore manual operation, high risk of getting hurt at work, pay more to subsidize the risk pool. But then, I've worked really hard over the last 5 years and I've had 2 solid years of my BMI, my height and weight being maintained. I can go back to the insurance company and I can apply to have that loading reviewed and removed.
Yeah, exactly. And again, that's why I would go back to Christina and say that happened 10 years ago, whether you took out the cover or not. If let's say you did, well, you can ask the insurance company or ask your advisor to help with it to review those loadings because again, I don't know the situation at all, and it's hard to make an actual comment. But given if you took it out 10 years ago, the outcome may be different today, and getting the insurance company to review that is definitely worthwhile.
Phil, the word that I was thinking of before was, and look, I say this knowing that it's happened to me, so I'm talking about me here. I've got a mental health exclusion on my policy. I've got a right ankle exclusion. I've got a loading for my trauma cover because there's a high chance of me having bowel cancer, right? So I've got a loading and I pay more. That can feel, and to be honest, I can't get any more. If I apply for cover tomorrow, I'm a decline because there's just too many things going on with all my surgeries, right? And I've got sleep apnea. If I applied tomorrow and got a decline on cover because of my current personal health, that does feel like the insurance company are discriminating against me. It does. And I want to say it might feel that way when you get a letter or a call from your advisor to say, hey, the insurance company won't offer terms. It does feel like discrimination, but it's not. They're protecting the insurance pool. Likewise, I can't be pissed off that the car insurer won't insure my car that's got hail damage. It's just a fact of life. Honestly, and it does sound like, and you'll probably be enraged at me, like, how dare you say that? I'm sorry, but insurance...
Well, it is discrimination, but they're allowed to discriminate, and they're allowed to discriminate based on statistics. That's really, there is an exemption for discrimination for insurance companies because they're taking on the risk and they're protecting the pool. And so that's kind of the nature of insurance is if you're, if you're a 21-year-old male and you get car insurance, you're going to be charged a higher premium because the statistical likelihood of you crashing is higher. Now, you may be a very conservative driver, but you're still a male, you're still 21 and you're still in that pool of higher risk.
And no one's forcing you to take out the car insurance. So I don't know. This is a landmine and, we are going to talk about some other mental health stuff. And I do say all this stuff, understanding everyone has complex health crap going on. And if you don't, you might one day. And if you don't, you'll know someone who's going through health crap.
And the other thing I would say as well to Christina's point about getting loading and exclusion is, again, I wasn't there 10 years ago when this happened, but was that an outcome from one insurer? Or was that did you go through the super fund and the super funds insurer said that at that point in time? Did you survey the market and get every insurer to respond to your medical history? So that's why what we do in our business, we do all that work up front before we pick an insurer because we know that has a massive impact on which insurer we would like to recommend to our clients because of these health things. And we'd like to have that discussion up front and say, hey, just be aware that these are the expected terms of an application. Let's not waste our time if you're really not keen on going ahead with these kind of potential terms.
You took the words out of my mouth that much like a mortgage broker, if I had 3 casual jobs which worked out to be a full-time hours and a full-time income and I walked into one bank at a shopping centre and they said, hey, you can't get a mortgage based on your situation. If I go to a mortgage broker, they can look and go, oh, we've got the exact lender who will absolutely hook you up.
Yeah, exactly. And the same with these things. Not every insurer is the same. Not everyone assesses the same. So it's just a matter of kind of, of course I'm going to say this, but engage an expert who can work with multiples. Your super fund only has one insurance company that they contract to. And Australian Super, they use TAO. And that's whatever TAO says goes when you apply through Australian Super. But you can set up policies with any insurer across Australia and you can still get Australian Super to pay that premium.
Now, Phil, we're just going to take a quick break and then we'll come back and continue the questions.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to sortyourmoneyout.com, click Get Help, and we'd be happy to introduce you to one of our trusted advisors. Our panel of advisors, mortgage brokers, and accountants work with clients all over Australia so they can connect with you wherever you are. That's sortyourmoneyout.com and click Get Help.
Okay, we're back. Now, just on underwriting with super funds. You may have an Australian super policy, you may have an Aware super policy, you may have an Australian retirement trust policy. Whatever you've got. Now, back in the day, again, I can only draw on my experience and I'll ask you, Phil, to see if it still happens. I had a client with, I think, Hester. She was a nurse. She had some default cover. It worked out that it was going to be, on balance, a more appropriate thing for her to increase her group income protection inside the super fund. And this was pre-rule changes and all that. So grain of salt stuff. But what I'm getting at is we applied to increase her cover with Hester. And because she was a nurse on the ward, she'd actually had a broken wrist within the last couple of years. Now, they said to her, we can't increase any cover. There was no mechanism in that group policy to just exclude the wrist and still cover her income. So we actually had to take out a supplementary policy outside super with another insurer that would give her cover and just exclude one part. So there is a little bit more flexibility with this personal underwriting with a retail insurer.
That's right. I mean, so these days you can increase the cover and they can allow you to do it and they can add exclusions on the policy.
But in a group policy?
Yeah. With the extra cover, there are some kind of like risk factors there, and things to note is sometimes they might want to put an exclusion on the full benefit. So if you've got $1,000 worth of default cover with Hester,
and it may have actually been something like that.
Yeah, that's often what will happen is like $1,000 of income protection, you want to increase it to $4,000 per month, and you're going to get an exclusion. They may put an exclusion on the full benefit. While otherwise what you could potentially do is hold that $1,000 and then hold $3,000 somewhere else. But again, there's a whole bunch of risk factors with all of it. I won't geek out too much, but Hester's one where they have an offset clause. If you get paid anywhere else, they're going to not pay you your income protection. So there's a whole bunch of kind of things to weigh up. And these policies with Hester, like the goalposts move as well. And so time
every 3 years
claim
you
claim in 10 years' time, well, that contract can adjust and change.
How's this? I had one super fund. I won't mention the name. Actually, I will. MTAA. It was a million years ago. Their policy, clients got a letter, and overnight, when they renegotiated the group rates, they said, "Hey everyone, we're changing the TPD wording, and it's no longer you're total and permanently disabled if a medical professional says you're unlikely to work ever again. We're changing the wording to if a medical professional says you're unable to work ever again." So you just got to think about that. One little word can change the whole policy. It would be harder for a doctor to say categorically unable to work ever again as opposed to probably unlikely to work ever again. Like, I'm more comfortable with that. So it's just wild. But anyway,
and some of the biggest super fund in Australia changed their TPD definition to saying unable to work again in your own occupation, and they added including the ability to retrain.
Jeez.
And so
that's savage.
Yeah. And so there are these things that the good thing about now, no one reads the full PDS, and I understand this, like no one's reading it, but the benefit of a retail policy is you own the contract. The insurer can't adjust these things. The downside of a super fund is the super fund owns a contract. The super fund's the one negotiating the terms. The super fund is the one paid on investment balance because they're all percentage-based fees. And so a super fund is judging the premium increase and says, do we want to dial back on these features or benefits because it's going to reduce the premiums, which is great because it can be in the member's best interest to make sure the premiums don't skyrocket. But they're being paid on the investment balance. So they kind of have an inbuilt incentive to try and make sure that the investment balance is increased. And it's just this difficult balance between insurance and super balances that you just got to manage and understand.
Gemma Geston said, if you have a pre-existing chronic health condition or disability, can you still get TPD insurance for it in the event that it becomes so severe that you cannot work? So just broadly speaking, pre-existing condition, well, I would say to Gemma actually, given what we've talked about, would NRMA insure your car if it had hail damage? We're just giving space for Gemma to answer.
Come on, Gemma. What's the answer?
Come on, we can't hear you. But that's a hard no, isn't it, Phil?
With the pre-existing chronic health condition, most of the time you're either going to get an exclusion, you may get charged more for it, or they may not even offer you cover for anything. But yeah, if it is a pre-existing health condition, and it kind of leads into long-term being a significant disability, the likelihood of you being able to get cover for that is almost impossible. Now, again, I don't know this situation. I don't understand what's going on, but generally speaking, the insurance company are going to look at that and look at your individual health, and they'll say, you know what, you're going to claim on this in the future, so we're not willing to cover that because it's just a guaranteed money going out of that bank account, and the amount that we need to charge you is $25,000 a year just to cover that money going out, and it doesn't make it sustainable for anyone.
There was an anonymous question that went up in the Facebook group just 10 minutes before we press go on the recording, and I'm just going to read it to you because it was actually good for this episode. Has anyone encountered an outright refusal for underwritten income protection or other insurances after disclosing historical drug use and or mental health diagnosis? So an outright refusal is a decline. Any advice where to go from here? For context, I've gone through a Glen James recommended insurance broker, but they've come back and told me that they can't find me cover. Time to boost that emergency fund, I guess. And that's basically, I mean, what are the options, Phil? Or do you want to talk about drugs?
Yeah, we could talk, high level. Now, look, as advisors, I couldn't care less if you take drugs. I couldn't care less if you're unhealthy. We don't really care. We're very pragmatic. This is what the insurers tells us, and this is what the outcome is going to be. So, like, any judgment aside about any drug use, let's just put that on the table that, you do you, boo. But from an insurer's point of view, they assess risk. Now, risk that you're going to claim because of a drug overdose or anything like that, that's not the risk that they're really worried about. They're worried about the risk of a behavioural risk of going, if you are taking illegal drugs, and so like things like cannabis generally are pretty fine. We can get cover if it's just cannabis. But if it's like MDMA, cocaine, things like that is, I don't know the law too well. I'm not a lawyer, but that's a lifestyle risk that you as an individual are taking on. And so from an insurer's point of view, how they kind of judge that risk is very difficult for them to put into a computer and spit out a kind of a risk assessment on. And we actually had another question in these other questions about surely most people in the My Millennial Money community, there is a lot of recreational drug use, and so how is anyone getting cover? And again, it's just a difficult thing for insurance companies to assess risk. And as a market, as an insurance market in Australia, that's a pretty clear-cut question that they ask. And it's generally if there's any recreational drug use within the last 3 years, unless we can really prove that your whole lifestyle's changed and there's been some, have a conversation with the underwriter about any external factors as to why that shouldn't be a risk factor anymore, it's generally a pretty hard decline.
So Uncle Glennie coming in with the street talk, they're more worried about you having a bit of goey and jumping off a bridge and being very injured.
I'm not an underwriter, but my understanding,
I can tell that.
Yeah, my understanding is it's actually less about the risk of you injuring yourself while you're on drugs or anything like that, but just more of how do we assess someone with that lifestyle?
They just can't quantify it.
Yeah, that's the difficulty. Like it's just a matter of going, oh, how do we assess that risk if someone's, taking recreational drugs? It's difficult.
Have you ever
to
taken
assess.
recreational drugs, Phil?
Me? No. I'm the most boring person you'll ever meet.
I haven't ever had a cigarette. I've never been drunk. I don't even drink.
Yeah, well. And you're still uninsurable. So all those people who are getting declined for recreational drug use, or Glennie here's barely done anything and he's still getting declined.
But these days, like, if you had a joint or whatever, they would just put you down as smokers' rates, wouldn't they?
Yeah, and that's why, like, marijuana, cannabis, all that stuff can sometimes be okay. Now, there are other factors involved. So, like, once or twice MDMA, cocaine in the last 5 years can be okay as well. Like, we've got plenty of clients who have had that. Like, if someone's dabbled, had a go, and then never done it again, that's okay. But it's more that kind of the regular, once every quarter,
I'm going to tell you a real story here, and this is a cautionary tale. Anything in life, you're going to lie, make sure you can get away with it. So, sure, there might be someone who, I don't know, gets a bit wild. And again, like you, I don't care what anyone does. But if you're going for an insurance application and you tell them, hey, yeah, I don't swallow a pill before I go to Future Music Festival or South by Southwest. I'm sounding really old now. What's a current cool festival?
I don't know. One of my team members is going to something. It's I don't even know. I'm so old.
Yeah, I'm a dinosaur now. And then you say no, I'm not doing that. And then because you're on medication for, I don't know, something that was unrelated to anything, and they said, look, we're just going to get a doctor's report to sign off, and you told your doctor once that you like popping the odd pill. There might be a question, has the client ever disclosed to you drug use or whatever? The insurance company finds out, decline. So if you told your doctor crap, you can't lie about it because the truth always is buoyant.
Now,
and so what happens if someone says to Uncle Philly, hey, Phil, yeah, I love, a nose beer every now and again. Is that going to impact me? My doctor doesn't know that I have nose beers.
Yeah, so I mean, the issue is as professional advisors, when we know something that will have an impact, we can't work with you and help you intentionally lie to the insurance company. So
it's a non-starter.
Yeah, and that's why for us it is a difficult situation because we have to go back to people who want cover and we understand their situation. We know that recreational drug use. I would love that not to have a massive impact on your insurance application, but we know what the outcome will be, and if you lie to the insurance company but tell us the truth, then we're in a really difficult. We've got a professional obligation to make sure that we're not intentionally helping you lie, and so we will kind of step in and say, hey, no, we can't act on your behalf and we can't help you with this because we know something that is true that you haven't disclosed to the insurer. Because at the end of the day, if a claim happened 2 years' time and it came out and you got declined, like that's not just my personal feeling that I would feel horrible if that happened with a client, but it's also my professional indemnity insurance.
Yeah. So Phil, I will say this, like we say that there's no retrospective underwriting at claim time because there really isn't unless there's exceptional weird circumstances that you took out the policy 2 weeks later, you were to die from I'll just be very extreme here, from a drug overdose. And on the death certificate, you sent the death certificate into the insurance company to get the money, and the cause of death was accidental drug overdose. 2 weeks after the claim, the policy's been put in force, that's a red flag, and the insurance company will reserve the right to go back and just double check that it wasn't fraudulent or there wasn't anything not disclosed.
That's right, and let's put drug use aside because that outcome is very low. The people who are taking recreational drug use, the likelihood of them overdosing on it is very low. But just on that disclosure and that application stage, they'll still want medical evidence about it. So I had a conversation with a client last week who we set up their policy without a mental health exclusion. Several months later, they were getting treatment and having symptoms for mental health. And I just said to that client, and now we're claiming on something that's kind of similar, kind of off. And I said to that client, I would just double check and just understand what the doctor's notes were at the time at which you got that mental health treatment. Because if the doctor's notes were for the last 12 months been having symptoms of mental health, then that could be an issue at claim time. Because the insurer may say, well, actually, you didn't disclose that you had these symptoms and you were getting this, you're having these feelings. And so that can be a concern, is making sure you are telling the whole truth and nothing but the truth.
So help you God. Now, I've said on this podcast for years that I was diagnosed and found out that I actually had anxiety and actually had depression in my late 20s. Now, I got my first income protection policy before I was diagnosed, before I knew. So, yeah, categorically, when I took out my policy, I had depression and anxiety, but I didn't know about it. So I didn't disclose about it. I'd never been to a doctor and talked about it, hadn't been to psychologists. So that was all good. So now technically there's I think 40% of my income protection benefit doesn't have a mental health exclusion. But because I've increased it in the future and then had depression and anxiety and take medication for that, go to the counselling, when I need to or whatnot, my increased cover has the exclusion. Phil, there's a question here from Beth Good. Glen James, can you please ask why they block you if you've ever been diagnosed with a personality disorder? I was misdiagnosed at 17 and last year I found out I'm autistic, and a couple of months ago I tried to get cover but was refused based on the fact I'd been diagnosed with a personality disorder in the past. Excluding people based on psychiatric conditions feels like a punch in the gut, especially when it stops them making healthy decisions for themselves because they don't have appropriate insurance. So, Phil, in your experience with conditions, autism, ADHD, what's the lay of the land with underwriting?
Yeah, so this is a really good question, and this is my first point is just because one insurer said that's the way that they deal with it, it doesn't mean that's the market view. So always, the insurance company, they're the ones taking the risk. So they'll decline you if they want to, but maybe not everyone will do it. So just to touch on this point, it was, personality disorder. No, I'm not going to touch too much on that, but found out that diagnosed with autism. Now, I called up an insurance company, an underwriter this morning, about how they classify autism, and it really is so personal. That's why underwriting, it's not a science. It's not something you just put in an Excel spreadsheet. It's really understanding you as an individual, and a good advisor will kind of help understand that and work through that. But how they do it is if you got autism, high functioning, minimal impairment, living independently, and no behavioural issues or mental health, then there may not be an issue with that at all. High-functioning autism is totally fine and there's no issues whatsoever. Now, if there are some kind of mental health conditions and symptoms and treatment in there, can have a different outcome. But if it's beyond that and there's like mild or moderate or severe autism, can be much more difficult getting cover. So we're probably we're looking more likely to get declined for income protection and TPD, and then maybe still getting some life insurance and trauma insurance. But again, I come back to it. It's just because one insurer said it doesn't mean all insurers are going to say it. And there's another question which I'll touch on, which talks to that point exactly. But yeah, it's really difficult without getting a full understanding. But yeah, there are different requirements for different insurers.
Phil, what if you're medically declined? Are there any other options?
Yeah, so The drug use question, just touch back on the drug use. There's very little options.
That's why I said medically declined. Yeah. Wink, wink.
But
leading the witness, Your Honour.
To be medically declined, there is a few insurers who will offer cover based on accidents only. So if you have an accident and you need the money because of an accident, well, we can get that cover. And the reason why we can potentially get that cover is because they're not making a medical assessment on you. They're making a judgment call on how likely are you based on your occupation, based on your age, based on your sex, to have an accident and claim on it. And so we can, look at getting accident-only cover.
And I actually had a client once who had an accident-only income protection policy. He was medically declined and we took out an accident-only income protection policy. He was a builder or carpenter. He fell off a ladder at work, broke his leg, and he couldn't work for 3 or 4 months, and he was on claim. It was perfect.
Yeah, exactly. And like, young males, I think 40% of all claims for young males for income protection is accidents related. So it still covers it.
You only have to look at my Instagram reel feed and you'll see why. I just want to touch on recreational activities. What's the deal? My name's Glenn. I'm addicted to skydiving. Can I get insurance?
Yeah, and again, it's all personalised. So generally, yes, they may put a skydiving exclusion on the policy. So if your chute doesn't work and you go splat, then you're not going to get paid out for that. Now, if you stop doing that, or if you don't do it at the time you apply, but then you start doing it, well, you're covered for it. And if you stop doing it, we can go back to the insurance company and say, hey, Glenn EJ over here, he's no longer skydiving. Can we remove that exclusion? And they'll do that. One of the things with recreational activities is like diving. So that's where, if you do scuba diving and you like going in shipwrecks, you're getting an exclusion. Yes, Glennie.
I was just about to talk about scuba diving.
Oh, amazing. Mind melding. Yeah.
We are in sync, my friend.
Yeah.
Because if you got your standard open water diving thing and you're like, yeah, I dive, we don't really go more than 18, 20 meters, we might do it once a month. Sure, they don't care. But if the risk increases and you go into those shipwrecks past, I'm making numbers up, past 20 or 30 meters, that's when they're like, look, we have to exclude scuba diving.
Exactly. Yeah. Yeah. And if you just got the snorkel on and you're snorkeling, who cares? There's the risk of a coral hurting your hand. Okay, well, we'll take that risk.
And this is why it's such a specialty, because within the health concerns that we may or may not have, there are insurers that will offer terms. Within some of the recreational activities that we do, there will be insurers, like some insurers
including drug use. Like once
use.
Off cocaine, there are a lot of insurers that will go, we don't even want to touch it. But there are some who are saying, like, once off, okay, we're happy to take on that risk.
Yeah, and give us some because we like to party too. Far out. Going to cancel my my contract with Tao after this episode, aren't I? But if you are listening, I really love your support.
No comment.
Let's move on.
What are you doing?
But like within that, some of the, for example, I'll pick and again, I'm so far out of this world. I'm just going to use an example. If you said I do mountain biking as a recreational activity once a month, they might say, yep, sweet. But if you say I do competition on the weekends.
Yep. Yeah, there may be an exclusion. Yeah.
So everything is so circumstantial. Let's move on. Yeah, Sylvia Powell, we'll just recircle around this. How exactly is pre-existing conditions assessed and how long do they last? They told me that having migraines, if I later had a brain tumour that is not present now, it could be considered pre-existing. I figured income protection is pointless. Can you please clarify? Look, that to me sounds like you need to talk to someone like Phil.
Yeah,
because
that to me that just sounds wrong. But I don't know. I don't know the situation.
We just don't know the details.
So I mean, we've got clients who have got a migraine exclusion, And so I went back and just searched our notes to see what is the writing, how is it written, this exclusion. And so our mates at Tau, the way they've written an exclusion for migraines is no benefit is payable under this policy for any claim resulting directly or indirectly from headaches and or migraines or any complication thereof. So it's got to be very, very clear that the brain tumour was made worse because of or a direct result of the migraines. And I'm no doctor, but that sounds like it'd be pretty far-fetched kind of decline. If they're declining a claim because of that, again, I'm not a doctor, not a claims assessor, but that's pretty far-fetched. And you could pretty quickly go to AFCA and complain about that outcome.
But I will say, Sylvia, like, for example, if you did get a decline because of migraines, like not even a policy with exclusion, and then life goes on and you've 5 years, oh, hang on, I haven't had migraines since I was 25. Like, oh, I'll go and apply. And if you said, look, I used to have migraines, I haven't had any since, and you might be like, well, technically, Glenn, if you always have migraines, like just go with me as an example. If you had something and you no longer have it, and it's been a period of time where you've been clear and no ongoing issues, time is your friend, in most cases that won't be an issue. Or likewise, Phil, like you could say, hey, I'm on blood pressure medication and have been stable for many years. Well, it's not even going to be a loading anymore.
That's right. And we are all special snowflakes. And we are all individuals, so that's why your individual situation needs to be assessed and reassessed over time. Like the migraine one, you're pretty rarely going to get declined because of migraines unless there's 3 other issues that kind of coalesces into a decline.
Really debilitating and very frequent.
Yeah, exactly. And that's the thing. Like, so my wife, she had 2018, she was in hospital twice because of migraines, had meningitis at the time. So if we apply for cover then, they're going to be like, look, just chill out. We want to see some time away from that ongoing migraines every few months. But now Kate hasn't, had any ongoing migraines because she's kind of managing that, through, the way she manages it. Now, the issue with insurance is once you set up the policy, you could eat Macca's every single day for every single meal. And if you have a heart attack in the future, you're still getting your claim. And so the insurers don't have any kind of mechanism to make sure you continue to look after your health. So if you can prove that you've been doing that and it's ongoing kind of management and really well managed, then maybe we can get cover for certain things.
Let's talk about pre-existing mental health issues. And there's a couple of anonymous ones here. And I'll just paraphrase. Couple of examples. I'm happily married. We had a bit of a fight. There was a bit of a rift in the relationship, and we both went to marriage counselling for 6 weeks with a psychologist. Surely that's not a mental health exclusion.
Well, it depends. Depends on the insurer's assessment. Like it can be.
Even if you're just doing it for preventative marriage maintenance.
And this is where the underwriters will want to understand this. And so, they will make a judgment call. And as advisors, we can argue on your behalf, and we do all the time argue. But also we kind of go, it depends on the situation. So we've had clients who, husband passed away 12 months ago, went to counselling. Of course, they're going to go to counselling. It's a no-brainer. And yes, it is rough that an insurance company puts a mental health exclusion on, but now she's, with another partner, building a life for herself, and we could get that removed in the future if there's no ongoing counselling and no ongoing kind of issue there. And that's kind of the concern with the insurers is if you're going to marriage counselling, and at the time you apply for cover and then the marriage breaks up and then it's really significant kind of divorce, ongoing issues there can lead to a kind of a more sustained mental health kind of concern. Well, the insurers are paying for that. And so that's why they are very risk adverse when it comes to mental health, because they don't know, is it going to deteriorate? Is it going to improve? Like what's the outlook? Because they're covering once and covering for the rest of the policy.
I mean, we can put a rover on Mars as the human race, but we can't quantify between the 2 years, basically.
And so the question that was asked was actually about employee.
Do you want to read that paragraph, Phil?
Yeah. So I've been told that anytime an employee accesses their EAP, Employee Assistance Program, it rules them out from commencing new income protection policies for the next 3 years on mental health grounds. So I'll just pause there.
Yeah.
So it doesn't stop them from getting cover. It may have cover with a mental health exclusion. So unless there's multiple kind of concerns, you're not going to get declined just because of that. So I'll keep reading the question. Even if they are discussing anything to do with mental illnesses with the EAP provider, e.g. they might have a colleague with difficult behaviour and just have a single session with the EAP to ask questions about strategies and managing interactions and relationships with that colleague. Is this true? And so the answer is yes or no, and it depends. So again, from an insurer's point of view, if they kind of look into that and they go, are you having kind of issues, relationship issues with colleagues? Well, you're going to have to work there. There's no guarantee that that colleague's going to leave or it's going to be improved. And so they always look at it as a risk assessment. What's the risk of that deteriorating? Because we're paying you if you can't work. Now, a significant amount of claims on income protection is mental health related. And that can be stress, can be anxiety, and all of these, the people who you work with can be the cause of that stress and anxiety. So that kind of one session just to kind of manage behavioral issues with a colleague, what can have an impact on your own personal mental health. And we all kind of know this, we all understand how mental health is so involved in what we do, and we need to make sure we're protecting our mental health and looking after it. But the concern from the insurer's point of view is if it does deteriorate, then we're protecting our mental health by getting an insurance company to pay us money because we're protecting it. So that's why they are super conservative. So if it is simply a session, hey, I want to be a better manager, and I don't have any issues, but I just want assistance in from a psychological point of view, how do I manage better? Well, maybe there's no mental health exclusion, and that's why more information is always, always, always better when it comes to assessing an insurance application.
And I think you can always ask for more information on the underwriting call. And I had a client once, and we got a mental health exclusion, and he was a, big burly bloke, big company he was running, and, great guy, and there was a mental health exclusion.
Because big burly blokes don't have mental health conditions? Is that what we're saying?
No, back off, mate. I'm saying that we all have a facade, and the facade, is never usually what's going on. And, if you're a big burly bloke, it's okay to be vulnerable and have mental health stuff. And he got an exclusion, and there was this thing with, I think he didn't want to tell me the whole scenario, but the doctor's report basically said, and the underwriter was kind and polite, and they don't disclose a lot of the information back to the advisor, but he just said, look, because I pushed, I said, look, we need to know what's actually, and he goes, look, loosely paraphrasing, there was multiple times where the work stress was getting to him, and the doctor said that he was, in his office crying about it, and it just was too heavy. And, there is stuff that comes out in doctors' reports that we might not tell the insurance company. We might not tell the advisor.
And that's right. And it can be on the positive as well. I was talking to the underwriter today about this autism situation, and the underwriter was telling me about a case where a client had high functioning autism with a mental health condition, and normally that may lead to kind of issues with the decline. But they read through the report, and the doctor said, well, this mental health condition's got nothing to do with autism. And so what happened, the underwriter was comfortable offering terms just with a mental health exclusion, and it didn't lead to a decline because the doctor's report was really positive to saying these are two separate things. And if the doctor said, well, this is kind of all wrapped together and there's maybe ongoing concerns, well, the underwriter has to take that information into account, and that's why those doctors' reports are really important, and that's why we try and follow up with the underwriter to understand as much as we can to relay what the thought process was from the underwriter.
Yeah, it's just about being honest, transparent, and asking questions. And what I was getting at, Phil, if you want to reach out, sortyourmoneyout.com, click get help, and get some insurance for your family, ask when I refer you to, likely it will be Skye Wealth, Phil and his team, or some other advisors, depending on what you need. Totally ask them about what's the underwriting process like, how does it work, and just you can say, look, I may have some questions about privacy. How is it dealt with? Like, it's all good, but it's just so important that we understand that it is a heavy process for some people sometimes.
That's right. And Glenn, I can tell your energy's low, and I've got a question I really want to address, and it goes to the kind of this initial process that we do in our as a team. So what we do is we ask a million questions up front about your health history, because it does dictate which insurance company we will recommend for you based on your personal, you're an individual snowflake and you're special, and so we want to place the insurance based on that and not just based on the price. Yeah, price is important. We don't want to be paying for the most expensive cover. But going to this question that we had was about family history of breast cancer. So background, my mum had breast cancer in her 40s, has a genetic testing which results showed her cancer was not caused by any known genetic mutation and therefore is not hereditary. So why am I getting an exclusion for breast cancer? And I'll touch on that by kind of reiterating the whole point of, one of the big points I want to make is just because one insurer will will have that outcome doesn't mean everyone does. So family history of breast cancer is really, really kind of a good example of this. So there are really two insurers who will offer this client cover without a breast cancer exclusion. It doesn't matter about genetic testing or anything.
But if they had a genetic test and they did have the BRCA gene, that's a showstopper with those insurers?
That's a little bit grey. So technically insurers can't use genetic testing as a factor. It's all about the family history.
Right.
And that was changed in 2019.
Sure.
It came out that they can't use genetic testing against your own personal situation, but they can use family history. So this client is a great example of why you should use a financial advisor, or Skye mainly. Is really
Whatever.
because
Phil, you are a trusted member of the advice panel.
No, but this is the value of an advisor who really works heavily in insurance space. Is we know that there are three insurers who would potentially offer you cover. One will put a loading on it, and the other two will just say, "Yep, we're comfortable," unless there was multiple family members with breast cancer. But most other insurers will put an exclusion on, and will or put a loading on the policy for family history of breast cancer.
So, Phil, talk to me, because again, I'm an ancient fossil. When I was doing this crap, if there was family history below certain ages of ovarian cancer, sometimes there would be an exclusion for breast and ovarian cancer because there was a link statistically.
That's right, yeah. And again, this is where this BRCA gene is really interesting kind of conversation about, it's not, a genetic mutation. I mean, we've had clients who their parents have had a melanoma, and therefore they've gotten exclusions because of it. And we've pushed back.
The parent had a melanoma and they got an exclusion.
Yes. And we pushed back and what is going on? And that insurer's decision-making tree, and they've got chief medical officers doing a whole bunch of stuff and making assessments. And their philosophy was, well, from a lifestyle point of view, we are very much a reflection of our parents. And so if the parent had melanoma because of a lifestyle, then the kids are high likelihood of doing it. And I pushed back and was like, that's ridiculous. Let's look at let's look at moving it. But again, it's just because one insurer says it doesn't mean everyone's going to do it. And that's why we try and do a lot of that heavy lifting up front, so we can kind of give clients an expectation, and we can just, instead of going and getting a decline or getting an exclusion for breast cancer, we know, okay, we're recommending X, Y, and Z insurer because of this outcome. Or, hey, your mum was under 40, really sorry, you're going to have that exclusion because of it.
And as time goes on, the medical world changes. And what an insurance company may have excluded or declined or loaded, I don't know, 10 years ago.
The goalposts are always
they
changing.
might accept today.
Yeah.
That's important to know. So if you do have a policy and you've had a loading or an exclusion and it's been in place for 10 years and it was for high blood pressure, but you're actually all healthy now because it was a lifestyle change, go back to your advisor and say, hey, can I get this reviewed?
Yeah. And even
likewise,
the age in
if
which
you've
you
given
take out the policy has an impact
Yeah.
on the assessment. Like if you're older, sometimes it'll be a better assessment because, well, you're not going to be on claim for longer. Like there's all these factors that come into underwriting assessments.
Or if you're still one of the 3 people who smoke, not many people smoke anymore, you may have given up smoking 2 years ago. Go back to your advisor, get them to review the smoking loading that you've got on the policy. What about vaping, Phil? Do they even ask that?
Yeah, so vaping's the same outcome as smoking. So smoking and vaping, you get charged a loading on the policy. So you get charged a higher premium for that
Smoker
additional
rates.
risk. Yeah.
Yeah, wow. Wild. Phil, we've kind of gone through the 2 pages of things. I wanted to just touch on one thing, and there's a trigger warning at the start of the episode, but I'll just do another trigger warning here around taking your own life. Now, every insurance application asks if you have attempted to take your own life. If the answer is yes, that's basically a non-starter in insurance land for any cover.
It depends on the length of time since. So
Right.
yeah, so even like ideation, so suicidal thoughts in the last 12 months can be an outright decline of cover. And so, yeah, if there has been hospitalization or anything like that, so we ask those questions up front, and all these are very personal questions. We understand that, but we ask them because we know it can have an impact on the cover. So suicidal attempts, suicidal ideations can have an impact unless we're quite a number of years away from that, and we can show that there is a change in life situation. So that's why you can sometimes get a mental health exclusion and a loading on it.
So yeah, please, if you are going through any type of stress, pressure, or you need any support, Lifeline is there, 13 11 14. Call them. It's a 24-hour crisis hotline. Please reach out to Lifeline. But Phil, would you say, if I could make a broad statement, and I don't like making broad statements, suicide attempts, a cancer diagnosis, major mental health event, surely it's a 10-year symptom issue-free window before insurance land. Like, because some cancers are like testicular cancer, they're not touching you for 10 years.
Yeah, and
I just want to set some realistic expectations.
The
cover isn't a non-starter.
The world is very grey, and so the only thing I would say for income protection and disability, they're the more difficult ones to get, and probably that's a reasonable kind of time frame. Yep. For life insurance, that's the easiest, but they might just charge you additional premiums. So it's not like a broad brush, you won't get anything. Yes, suicidal ideation and attempts, hospitalizations, we're probably talking 5 years away,
right?
Unless there's any still ongoing mental health conditions and treatment. Then it can be maybe a bit longer than that. But yeah, cancers, again, it depends. Like there's some things where it's just like thyroid cancer and that was dealt with, then we can get cover in a more reasonable time frame than that. But if it was a more like, bowel cancer, then we're struggling to get cancer within that 10-year time frame. That's
struggling
very
to get cover.
broad brush.
You said cancer, struggling to get cover in that 10-year time frame.
Yes, sorry. Yeah.
So yeah, this is a complex area. And the reason why we kind of say get cover set up while you're young, because you've got a better chance of being healthy while you're young. Like, it's just wild. But I will say, like, talk to us, Phil, in finishing. If I've got an exclusion for my right ankle, which I do on my TPD And this is what I do, right? So I've got a right ankle exclusion on my TPD. I can't think of a scenario under the sun where if I had my right ankle chopped off that I would be totally and permanently disabled. Like, so for me, sure, throw the exclusion on, like whatever. It's actually a non-starter, but it's just insurance land. They've got to do that stuff, right? But on my income protection, I've got a right ankle exclusion. So if I run down my driveway today, crack my ankle, and I can't walk or work for 6 months, sure, that's an exclusion. But does that mean I can never claim on it? Like, are there scenarios where I can still?
Yeah, so the wording of the contract, and I mentioned this quickly before just about the wording of the migraine issue, was that at the point of claim, no benefit is payable under the policy for any claim resulting directly or indirectly from that ankle. So if you injure yourself playing football and it was an accident, but the recovery was delayed because of that pre-existing condition, then they won't pay out a claim on that because, it's a pre-existing condition, there was an exclusion and it's made worse because of it. And there's argument to say the ankle's weaker, so therefore it's related. If you're in a car accident, you break your leg and including your ankle, and you can't walk because of it, well, a doctor can easily say that, well, that had nothing to do with the claim. The car accident wasn't a result of the sore ankle, and it's not made worse because of it, because the way the car crash happened, it completely crushed your leg. So it's not made worse because of, it's not the cause of it, so they can still pay out a claim if you can't walk on that ankle because of that car accident.
Yeah, cool. Good hustle. I'm done. I've checked out. But
yeah.
Hey, everyone. Sorry, I just opened my email, start reading. I'm like, I'm not good at meetings and I just check out. But Phil, I hope that was helpful, everyone. Like, we've talked for almost an hour and a half just around the complexities of underwriting. And I would encourage anyone, if you've got a job, you need to protect your income. And I need you to consider income insurance. Like, everything we do in our financial house comes down to making sure the money never stops. And if we can't work due to accident or illness, we absolutely need to make sure the claim will be paid. Don't be freaked out when you hear stories on a current affair with the claim not getting paid. Insurers pay bucket loads of claims. Trust me. It's just...
Yeah, Tail's paid over $1 billion of claims every single year.
It's the amount of claims that get paid, it's just so ridiculous and wild. And if I had a policy that I could claim when I broke my toenail, well, that's ridiculous. It just means the premium would be $200,000 a year because we can't quantify everything. So that's why with insurance policies, they've got to draw a circle around things that can be quantified and covered. Otherwise, the policy would be like, we'll cover you for unlimited things. So it all goes back to understanding how the insurance pool works, how underwriting, the process works. Be in contact with your financial advisor regularly. If you have a mental health condition, give as much detail as possible. It's okay. Phil and his team, they are understanding and they get it. I mean, yeah, it's just wild. And it does feel embarrassing sometimes, but go at your own speed. It's all good.
Yeah, and I would just recommend going through a financial advisor, whether it's us or anyone else, just make sure you're having a really robust discussion or the advisor's collecting a lot of information about your health history, because a lot of our recommendations to an insurance provider comes from we're pairing this insurance provider to you because of your health history. Now, price is an impact and we care about price because we're paying that money, but I'd much rather cover that ankle or cover that back that you've got a pre-existing condition with a more expensive provider than just making a recommendation based on price. So going through your super fund, that's an option, but they've got one insurance provider. So if you're not happy with that outcome, then have a chat to a financial advisor, making sure you're having a really robust discussion around your health history, because that will have a massive impact on which insurance provider is best suited for you.
So there you have it. I would encourage anyone to reach out to sortyourmoneyout.com, click get help. I'd love to introduce you to a quality financial advisor to review your insurance, to take out some insurance, to get some recommendations based on your situation. If you've already got an advisor and you haven't reviewed your policy for some time, one, why haven't they written to you? But honestly, go back and speak with them because they actually service the policy and they're in your corner. Phil Thompson, Skye Wealth, thanks so much for joining us today.
Thanks, mate. Thanks for having me.
We acknowledge the Awabakal people, traditional custodians of the land on which our studio sits, and pay respects to their elders past, present and emerging. We extend that respect to Aboriginal and Torres Strait Islander peoples who may listen to our podcast. My Millennial Money supports a variety of charities, and we encourage you to consider giving as part of your overall financial strategy. If you would like some giving options, or if you're unsure about which charity you can support, head to mymillennial.money/charities for more info. This podcast is for education and entertainment purposes. Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the product disclosure statement, target market determination, and obtain appropriate financial advice tailored to your needs. Simo Interactive Proprietary Limited, the publisher of the podcast, and Glen James are authorised representatives of Money Sherpa Proprietary Limited, which holds financial services license 451289.